Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial jargon that usually puts you to sleep with a bit of a smirk, because today we are diving deep into gaming and leisure properties and their recent big move involving a massive debt offering. So what exactly is going on with gaming and leisure properties, or GLPI, as they're known in the financial world? Well, on August 27th, 2025, they closed a massive offering of notes, more than $1 billion, almost $1.3 billion to be precise. Now, this isn't just some small company borrowing money. This is a significant financial maneuver. So let's see what it means for them and for us as observers of the corporate world. Think of it as them issuing IOUs to a lot of investors to get a big pile of cash. GLPI is a real estate investment trust, which means they mainly own and operate properties that generate rental income. Their business model is pretty straightforward. They own casinos and resorts and lease them out to gaming companies. So companies like Penn National Gaming or others operate the actual casino world. Their common stock is traded on the NASDAQ under the ticker GLPI. So if you're into casino real estate, this is a company you might already know or be watching. Now let's get to the juicy part, the actual details of this debt offering. This report is all about a specific event, the closing of their notes offering. It essentially means they successfully sold these IOUs to investors. So as we just said, they raised $1.3 billion by issuing these notes. These notes are essentially loans to the company. This money came from a couple of entities, GLP Capital LP, which is their operating partnership, and an indirect subsidiary called GLP Financing 2 Inc. The notes themselves are divided into two types. There are senior notes due in 2033, so they have to be paid back by that year, and senior notes due in 2037, meaning they have to be paid back by 2037. These notes are like loans that are not backed by any specific assets, but they do have a guarantee from the main company GLPI, which adds a layer of security for the investors. Being unsecured means if things go really bad, the people who bought these notes don't have a direct claim on specific buildings or properties, but they do have a claim on the company itself. Let's talk about the interest rates. For the 2033 notes, the interest rate is 5.25%, and for the 2037 notes, it's 5.75%. These are the costs of borrowing this vast sum of money. They have to pay this interest regularly to the people who bought the notes. Now, here is something interesting. The company has the option to pay back these notes early. They can do this before a certain date near the maturity date. The company calls this the par call date. If they do this early, the price they pay back is a bit more complicated. It's calculated based on the present value of the remaining payments plus a small extra amount called a spread. Think of it as if they are paying off a loan early and they have to compensate the lender for the interest they would have earned over the full term. This gives them flexibility if interest rates fall significantly. After this specific par call date, they can redeem the notes at the exact face value plus any interest earned up to that point. This is a more standard early repayment clause. Again, the guarantee from GLPI is crucial. It means the parent company is on the hook if the operating entities can't pay. These agreements for borrowing money, the indentures, are not just about paying back the money, they also come with rules for the company. These rules are called covenants, and they limit GLPI's ability to take on even more debt or to use their assets as collateral for new loans. They also restrict merging with other companies. These are standard protective measures for the lenders, ensuring the company doesn't take on too much risk. A really important rule here is that they have to keep a certain amount of assets that aren't already promised to other lenders available to cover their unsecured debt. This is like making sure you have enough of your own money put aside before you borrow more without collateral. The document also spells out what happens if things go wrong. These are called events of default, missing interest payments or principal payments, failing to follow the rules in the agreement, like the debt limits or having too much debt compared to your unpledged assets, or even going bankrupt, are all reasons the lenders could demand immediate repayment of everything owed. Let's talk about the pricing. The company didn't sell these notes at their full face value. The 2033 notes were sold at about 99.87%. This means investors got a tiny discount when they bought them, which is a common way to sweeten the deal for lenders. After paying all the fees associated with this massive sale, they brought in about $1.28 billion. This is the actual cash they have in hand from this deal. So what are they going to do with this mountain of cash? The main plan is to pay off almost $1 billion of their existing debt, specifically their 5.75% senior unsecured notes that were due in April 2026. They are paying these off early, and it looks like they're paying them off at face value plus interest and a make-whole premium, which is that early repayment fee we talked about. So it's a refinancing move, essentially replacing older debt with this new cheaper, if you consider the longer terms possibly, albeit higher amount of debt. They have about $300 million left after paying off that old debt. This money is earmarked for general business needs, which could include building new casinos, expanding existing ones, paying off other loans, or just general operating expenses. This shows they are keeping some cash on hand for flexibility and growth opportunities. Now, anytime a company talks about the future like this, they have to include a disclaimer called forward-looking statements. This section is full of warnings that their actual results might differ from what they expect. They specifically mention their ability to use the money as planned. This is important because plans can change or run into roadblocks. One of the most significant risks they flag is their ability to maintain their status as a REIT. These rules are super complicated and very technical. If they mess up even a little bit with things like owning enough income generating property or distributing enough income to shareholders, they could lose their REIT status. This is a big deal because it means they would be taxed as a regular corporation, losing a major tax advantage. And some of these rules depend on what their tenants do. Imagine being a landlord and your tenants' actions could accidentally affect your tax status. That's a real risk here. They also highlight a risk related to their tenants, the companies that actually operate the casinos within GLPI's properties. GLPI depends on these tenants to pay their rent reliably and meet their own financial obligations. If these tenants struggle financially, GLPI could face major problems, so their success is tied directly to the success of the casino operators they lease to. Another point is that their tenants need to follow all the laws and regulations related to running casinos. If a tenant messes up and gets shut down or fined, it could impact GLPI's income too. They also mention general real estate risks like potential environmental problems at their properties, or the fact that real estate generally can't be sold quickly if they need cash fast. Finally, the filing lists out all the supporting documents. These include the original agreements for these notes and amendments. This specifically points to the agreement for the 2033 notes, and this one for the 2037 notes. These are the legal documents that lay out all the fine print and obligations for this massive debt deal. So what's my take on all of this? Gaming and leisure properties just took on a huge amount of debt to refinance existing debt and get themselves another chunk of cash for general purposes. On the surface, this is a smart move to lock in potentially lower interest rates for longer periods, especially if rates are expected to rise or stay high. They are essentially swapping out some short-term debt for long-term debt, which can be a good strategy for stability. However, the significant increase in their overall debt load is a major point of concern. While they have covenants in place to manage this, GLPI success is heavily reliant on its tenants staying financially healthy and compliant with all regulations. The risk of a tenant failing financially is a direct threat to GLPI's income stream and its ability to service this new debt. Furthermore, maintaining their REIT status is a complex balancing act, so watching their asset and income distribution strategies closely will be key. The company is showing a proactive approach to managing its debt structure, but investors should be aware of the concentration risk tied to their tenants and the ongoing complexity of REIT regulations. It's a company that bet on the long-term stability of casino operations, but the macroeconomic environment and tenant-specific risks are definitely things to keep an eye on. So that's our deep dive into Gaming and Leisure Properties' recent debt offering. What are your thoughts on this move? Do you think taking on more long-term debt is a smart play or too risky given the current economic climate and the reliance on their tenants? Let me know your opinions in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe to Corporate Decoder for more unbiased breakdowns of financial news. And don't forget to join our Discord community, linked in the description, for even more exclusive content and discussions. Thanks for watching, and we'll see you in the next video.